Welcome back to our personal finance channel, Finance SuperGirl, your go-to source for personal finance tips and insights. Today we're going to dive into a crucial topic that affects every saver and investor: the impact of inflation on your savings. Section 1. What is inflation? Inflation is the gradual increase in the prices of goods and services over time. It erodes the purchasing power of your money, meaning that the same amount of money can buy less in the future. While a low and stable inflation rate is generally seen as a sign of a healthy economy, it can have a significant impact on your savings if not properly managed. Inflation is influenced by various factors such as changes in supply and demand, government policies, and global economic conditions. It's important to understand that inflation is a natural occurrence in any economy, and its effects can be felt on your savings and investment returns. Section 2. Problem identification. The problem arises when the rate of inflation outpaces the growth of your savings. Let's say you have $10,000 sitting in a savings account earning a modest interest rate. If the inflation rate is 3%, the real value of your money will decrease by $300 over the course of a year. This means that after 1 year, your money will have the same nominal value of $10,000, but it will be able to purchase less due to the rise in prices. Over the long term, the impact of inflation can be even more significant. If inflation averages 3% annually over a decade, the purchasing power of your money will be reduced by almost 30%. This can have a detrimental effect on your ability to meet financial goals, especially when it comes to saving for retirement or other long-term objectives. Section 3. Strategies to mitigate inflation impact. So, what can you do to mitigate the impact of inflation on your savings? Here are some strategies. Invest wisely. Consider exploring a diversified investment portfolio that includes assets such as stocks, bonds, real estate, and commodities. Each asset class has its own characteristics and may respond differently to inflation. Stocks, for example, have historically provided returns that surpass the inflation rate, making them an attractive option for long-term investors. Bonds can also be a good choice, especially inflation-indexed bonds or bonds with fixed interest rates that outpace inflation. Diversify your portfolio. Spreading your investments across different asset classes and industries can help mitigate risk. By diversifying, you ensure that if one sector or asset class is affected by inflation, the impact on your overall portfolio is minimized. Consider allocating your investments in a balanced manner based on your risk tolerance and financial goals. Real estate, commodities like gold or oil, and international investments can provide further diversification. Stay informed and adjust. Keep yourself updated on market trends, economic indicators, and inflation forecasts. Periodically review and adjust your investments in response to changing economic conditions. This might involve rebalancing your portfolio, reallocating assets, or even exploring new investment opportunities. Consult with a trusted financial advisor who can guide you through these decisions and help you adapt your investment strategy to changing inflationary environments. Consider inflation-protected securities. Explore investments like Treasury inflation-protected securities, TIPS. These bonds are designed to adjust with inflation, protecting the purchasing power of your money. TIPS pay both a fixed interest rate and an adjustment tied to inflation, ensuring that your investment keeps up with rising prices. By investing in TIPS, you can preserve the value of your savings even in inflationary periods. Focus on income-generating assets. Look for investments that generate income, such as dividend-paying stocks, rental properties, or real estate investment trusts, REITs. By focusing on assets that provide a steady stream of cash flow, you can offset the impact of inflation and potentially grow your income over time. Dividends from stocks and rental income from properties have the potential to increase over time, helping you stay ahead of inflation. Plan for long-term goals. When saving for long-term goals like retirement, consider investing in assets with higher growth potential, such as stocks and growth-oriented mutual funds. While they may experience short-term volatility, stocks historically have outperformed inflation over the long run. By investing for the long term, you can harness the power of compounding returns to combat the erosion of purchasing power caused by inflation. Consider inflation hedging strategies. Some investors turn to inflation hedging strategies like investing in commodities or real estate. Commodities like gold, silver, or oil can act as a hedge against inflation as their prices tend to rise during inflationary periods. Real estate investments can also offer a measure of protection, as property values and rental income can increase with inflation. Increase your earnings. One way to counteract the impact of inflation is to increase your earnings. Look for opportunities to boost your income through career advancements, side hustles, or developing new skills. By increasing your earnings, you can stay ahead of inflation and have more resources to invest and save. Minimize debt. High-interest debt can be detrimental to your financial well-being, especially during inflationary periods. The interest on debt doesn't adjust with inflation, which means the real cost of borrowing increases over time. Prioritize paying off high-interest debt to reduce the impact of inflation on your finances. Control your expenses. As prices rise due to inflation, it's important to control your expenses and make conscious spending choices. Look for ways to cut unnecessary expenses, negotiate better deals on essential purchases, and adopt frugal habits. By being mindful of your spending, you can maintain your purchasing power and save more for the future. Regularly review and adjust. Inflation is not a static phenomenon. It fluctuates over time, and its impact on different sectors of the economy varies. Regularly review and adjust your investment portfolio and financial plans to adapt to changing inflationary environments. Stay informed about inflation trends and seek expert advice when needed. Remember, understanding the impact of inflation on your savings is crucial for long-term financial success. Don't let your hard-earned money lose its value over time. Take action today to protect and grow your wealth. If you found this information helpful, be sure to give this video a thumbs up and subscribe to our channel for more valuable personal finance tips and insights. And as always, we'd love to hear your thoughts and questions in the comments section below. Until next time, stay financially savvy. Thank you for watching today's video. Be sure to check out our other videos on various personal finance topics. And don't forget to hit that subscribe button and bell icon to get notified whenever we release new content. Remember, your financial well-being is within your reach. See you next time on Finance SuperGirl.